Welcome, everyone. Firstly, I'd like to acknowledge the Gadigal people of your nation, the traditional custodians of this land, and pay my respects to elders both past and present. I'm Carmen Ridley. Now, Carmen is a Principal Director of the Australian Financial Reporting Solutions. She's a member of GAAP Consulting and a former member of the Australian Accounting Standards Board. So if there's anyone more qualified to talk to us this morning, I don't think there is. So Carmen will talk to us for just over an hour. Questions, if you get any questions, just raise your hand or shout out. And Carmen will take those as we progress. All right, so without further ado, I'll pass you over to Carmen.
So my plan for this session, I told Aidan he had to say just over an hour because I think I've overestimated my content and underestimated my time. So I'm planning on just talking to you very briefly about the new standards that are in place at 30 June 23. Then a couple of things that the ACNC have done and a reminder for anyone in the room who's from an aged care. Then what we're going to do principally is we are going to complete the AASB survey on their proposed tier 3. Now, what Aidan didn't mention is there may be two people in the room who are more qualified to talk about this than me. We have two members of staff from the AASB who are in the room. So we've got Freddie and Maggie who are here with us. They are here to observe, to listen to any comments that have been made, but also if I have overestimated my content, we've also got three of us who can stick around at the end to help you with the survey to finish that if you want to. So that's the principal thing of what we are going to do today. So the good news is that there are pretty much no new major standards for you at 30 June. I know I often either stand not here, it's the first time we've done it here or virtually, telling you that there's lots of things that you need to think about. There really isn't for 30 June 23. So a couple of things to be aware of. There is one standard that deals with, it's called an annual improvement standard. It's got very minor changes. Don't expect it to be impact for anybody. The other one that may be useful for you is the AASB as part of their narrow scope project on income, which I've talked to you about previously. There was a standard that came out that has introduced an extra example into the revenue standard. So it deals with upfront fees. So where you charge basically a joining fee and how you account for that. So there's a worked example. It mainly deals with principals. So if you do have any of those upfront type fees, just something to be aware of, some extra guidance there for you. But the good news, pretty much no new standards for you, so you don't need to worry about that. So in relation to the ACNC, so those of you who are registered for the ACN or registered with the ACNC, you hopefully are familiar that at 30 June 22, the ACNC required disclosure of key management personnel remuneration. So even if you're doing special purpose financial statements, you are still required to disclose that key management personnel remuneration. What the ACNC have decided is that related party transactions is actually a really important thing for people to know. And they've had a number of concerns about related party transactions. So stage 1 was the KMP remuneration. Stage 2 is the related party transactions. So for 30 June 23, all entities who are registered with the ACNC will have to report some form of related party transactions, either in the annual information statement if you are a small charity, or in the financial statements with some more information in the AIS if you aren't medium or large. So if you are doing general purpose financial statements, you're already doing that. That's not an issue at all. It's if you're doing special purpose financial statements. Now, this one is possibly a little bit harder than the key management personnel remuneration because you have to capture that information for related parties. So firstly, we have to identify who our related parties are, and then we have to identify any transactions. Now, one of the traps of this is you need to report those regardless of whether a fee has been charged. So if you've given a related party something for free, you still have to report that. And in fact, it's often more important to report that because you wouldn't give something to a non-related party for free, generally in that context. So making sure that you've got the systems in place to be able to do that is really important. Please, please, please do not wait till after 30 June 23 to start trying to get this information because it will be chaos and trying to go back and capturing will be really challenging. If you have a change in key management personnel during the year, make sure you capture that information before they wave goodbye to your organisation because it is much harder to try and get that information when they're not actually with you anymore.
Practical question.
Right, yeah.
How do you define a related party?
How do you find, so sounds like it's a really easy question for me to answer. The definition I would take me 5 minutes to actually work through each component. So effectively, I'm going to give you the high level answer. Related party is any key management personnel and any close family members of the key management personnel. So if, for example, I'm a director of your not-for-profit and my partner was a partner in the legal firm that we use, that would be a related party. It also includes any entity that you control, that you have significant influence over, that you may be in a joint venture or a related relationship in that way. So the definition is quite long. That's effectively in principle. Control, significant influence, any type of other relationship. It's exactly the same as corporate. It's no different from the corporate definition because it refers you back to the standard to do that. Yeah, so it's exactly the same as the corporate definition. The ACNC have not defined a not-for-profit definition of related parties. Yeah. The other thing that the ACNC have done is, and I have to admit, I'm not overly sure what this is going to mean and what we'll see. Because they've introduced related parties, we've got an extra standard added to the suite of standards that special purpose have to prepare. So we've got or have to comply with. We've got our 101, we've got our 107, 108, etc. So they've added in the related parties to that. So you have a choice now if you are doing special purpose financials with the ACNC. You can choose to comply with just the mandatory standards, or remember I've talked to you previously about we now have 2 tiers of financials, and tier 2 is simplified disclosures, which is all in 1060, effectively one standard that's a big disclosure checklist. You can choose in your entirety to comply with AASB 1060. So effectively ignore those mandatory disclosure standards and just do 1060. Some things there's probably less disclosure, some things there's probably more. Highly up to you, but it's a disclosure choice you now have if you are doing special purpose financial statements. If you're doing general purpose financials, I would expect you all to be doing tier 2 anyway. All right, then my next thing is for any aged cares in the room. So just a reminder that and I'll just check my date, from the 1st of July 24, bed licenses are no longer going to exist. So if any of you in the room are aged care and you still are not depreciating or amortizing your bed licenses and aren't doing impairment testing on them, please, please, please start doing that as soon as you could yesterday, because they will not exist from 1st of July 24, so we cannot carry them on our balance sheet. They're not an asset. It's much better to be depreciating them or amortizing them over a period rather than taking a massive hit at 30 June 24. So that one's only for aged care providers. All right. The next thing I want to talk about is post-implementation reviews from the AASB. So a post-implementation review is what happens a couple of years or so after a standard is issued. And it's the opportunity for the AASB to say, we issued a standard to do a certain thing. It was intended to do this. Is it doing what it's meant to do? So what the staff do is they collate any issues that they're aware of with that particular standard that was issued, and they go out effectively to the stakeholders and say, this is what we know. Can you tell us how it's working? Can you tell us anything we're not aware of? So the board can then do effectively a debrief to say, is this standard doing what it should? Do we need to put out some more educational material? Do we need to change the standard? Do we need to just tweak a couple of things? Or is it doing what it should and therefore we can move on? So the AASB is going through a big post-implementation review for not-for-profit domestic standards. The post-implementation reviews that are happening at the moment is in relation to revenue. So that is the interaction between 1058 and AASB 15. And I know many of you in the room probably have quite a few things to say about that one. In relation to control and consolidation. So if you are a not-for-profit, how does that work? For the public sector related parties, structured entities for all entities, and disclosure in special purpose financial statements in the not-for-profit sense. So if there's any of those that you are interested in, the link is on the slides. The more feedback that the board can hear in relation to any issues that you might have on those particular topics, the better informed they will be to decide if there are any changes that need to go through to those standards. It will not surprise you to know the one we are hearing the most about is revenue or income. So there's a big list of known issues in that paper that has come out. complete questions 1 to 3, which is just your what type of organisation are you from, and I will meet you at question 4. So the AASB are proposing a 3rd tier of accounting standards. So I've mentioned already that we've got tier 1, which is our full IFRS standards. We've got our tier 2, which is our simplified disclosure. But one of the comments that the AASB hear quite often is that for certain not-for-profits, the AASB has put out a proposal for a 3rd tier, which will be for certain not-for-profits and quite different from our tier 2, which is exactly the same recognition and measurement. This will actually be simplified accounting requirements. So it is a balance between making things simpler for the not-for-profits and retaining the, principles within the conceptual framework. So at this point, what the board has released is a discussion paper. So a discussion paper then will get analysed, then it's an exposure draft, then it's a standards. It's a very early stage to effectively allow the board to determine whether this is something that the stakeholders want. Now, given the people I have in the room, you are the perfect stakeholders that the board want to hear from. So hence we are going to work through the survey together. It is your opportunity to directly respond to the AASB. So what we do have is we have a number of resources that are out. So I appreciate that the people in the room are the only people from their organisation in many cases. If you feel that there is somebody else from your network, your organisation who would love to answer any of these, those links are there on the AASB website, some extra resources there for you to pass on to them. So I said I'd meet you at question 4. Question 4 is that the plan is that the standard will be a one-stop shop. So rather than you having to jump into the principal standards and then another standard for disclosures, it is very much you pick up this standard and that is where everything you will need to know will be. And ideally, will be written in plain English, as plain English a standard as anybody can get. This is accounting standards. It's not going to be absolute kindergarten English, but as plain English as we can possibly get. So the first question that I'm hoping you can answer now you've caught up with me is, do you agree? Do you think that that's what it should be? The answers are all, the questions all have yes, no, or not applicable to me answers. You are very welcome to put in comments, but I appreciate that in this time, you may not have chance. What I would ask, however, is if you do disagree with anything, if you could put in a comment, that would be fantastic. Question 5. So I've talked about there would be 3 tiers of accounting standards. What the board are thinking at this stage is that if any not-for-profit who is able to use tier 3 decides that actually they don't want to, they would much rather use our tier 2, they would much rather do the numbers that they were used to with those disclosures, that they can. So they can opt up completely in their entirety. So that's over on the left-hand side. What the board's not sure about is what if not-for-profits wanted to opt up for certain things. So let's say, for example, your leasing standard. You currently do the leasing standard and you love it. You think it's the best thing ever. So you think it'd be stop the laughing. There'd be a retrospective grade to go back and we'll look at what's proposed. So you want to keep doing this leasing. So this is the opt-up question. Does the board allow you to keep with your leasing standard under the old standard and use everything else in tier 3? So option 1 would be yes, whatever you want. If you want to go up a level, you can, because that's conceptually more pure, whatever you want to do. Option 2 is the board might pick 5 things and say if you want to opt up in any of these 5, you can. You can't for anything else. So if leases within my 5, you can. If not, you can't. Option 3 is no. You are in tier 3, you are in tier 3, you are not picking and choosing any other guidance that you've got. So the question in question 5 that you're looking at is, should opt-up be allowed? And again, if in the comments you have a particular preference for one of the options that I've got on the right-hand side, feel free to type that in there. So is it all in, or do we let them jump up on certain things? All right, I'm going to keep moving at a pace that I think is okay, but shout me if you need me to stop. The next question is consolidation. So I mentioned that the AASB were doing their post-implementation review on consolidation and looking at their control model. Some of the feedback that's happened is often when you end up looking like you control an entity, it doesn't end up with the right answer for not-for-profits. So what the board is proposing in relation to this is to say, we'll give entities the choice about consolidation. So if they have an entity that they control, they can choose to consolidate it and prepare consolidated accounts. Or they can choose not to. If they choose not to, there will be disclosures on significant relationships. Now, the board at this stage hasn't determined what that will be, because this is still at that, if everybody hates that idea and thinks we should consolidate, the board's staff is not going to spend the time actually working on what that would look like. That would be more of an exposure draft phase. So the question that I've got for you here is, what do you think? Do you think consolidation should be a choice, which is what is proposed? People very vigorously nodding in the audience to that one. Or do you actually think that no, if you control, you should consolidate? So I'm interested in thoughts on that one. And again, if you've got any questions, just please stop me. And if I can't answer, we'll look to one of my people in the front. Question 7 is using that awful terminology of non-financial assets acquired at significantly less than fair value. It is horrible, but nobody can come up with a better terminology to use. So we all keep using this. This is where, as a not-for-profit, you have either been given something for free in order to help you fulfill your objectives, or you've been sold something at a huge discount because somebody says, love the work you're doing, can't give it to you for free, but I'll give you a massive discount because I want you to help fulfill your objectives. It's not I bought a bargain on Black Friday sales. So it's not that. It's been deliberately given to you to help you fulfill your objectives. So at the moment, what we have to do if that occurs is we have to fair value that asset on day one, and any difference between what you paid and its fair value goes to income. What the proposals are under the tier 3 is, again, you will have a choice. So you'll see that there's a number of choices within this particular standard. It's still within a framework, but it does mean that certain comparability is lost because obviously different entities may make different choices. So the choice is that you can choose to just hold it at cost. So if I've been given a piece of land as a not-for-profit to help me do my work, I would hold that land, but it would be valued at 0 within my books. And I'm not permitted going forward to revalue that amount. It's always held at 0. I would disclose it, but it's not actually being recorded in my balance sheet. Or I have fair value. So I do exactly what I do now, is I would record it at its fair value and take the other side of that to income. So that's for anything that's given to you for free or that you purchase for significantly less than fair value to help fulfill your objectives. Question 8, to do with impairment. The board spent a huge amount of time.
Quick question on that last one.
Yeah.
I presume that by category of assets, you can't do it on an individual asset by asset. It's going to be categories. Is that right?
It would be on an asset by asset, yeah.
Asset.
Because you're not necessarily, you could be given a piece of land and then nothing else. It would be asset by asset, yeah, with the disclosure. The board spent a fair bit of time on impairment. We don't often see much impairment in the not-for-profit sense, but it was still deemed to be a really important topic, and therefore there needed to be something on there. So when there was discussion about how could we simplify the not-for-profit impairment, what the board decided was at this stage, the simplification will be through the impairment indicators rather than the process of calculating whether there is an impairment. So at the moment, we have a list of impairment indicators in the standard that you are meant to look at, and then you're meant to consider whether there's any entity-specific indicators. What the board have decided is that if, or proposed at this stage, if your assets are measured at fair value, they don't need to be tested for impairment. By measured at fair value, what they mean is that you are constantly measuring at fair value. Not that you measured it at fair value 10 years ago and you're still saying it's at fair value. It's a constant update of fair value. If they're measured at cost, what you do is consider whether one of the specified indicators exists. So is the asset physically damaged, or has the service potential been adversely affected? So I bought a particular asset because I had won a 5-year contract to perform something under a grant. 3 years into that grant, the grant was cut. So that activity is gone. So therefore, the service potential of that asset is adversely affected. If either of those criteria exist, I am required to do my impairment testing. If they don't exist, the not-for-profit is not required to do their impairment testing. So they would be each year required to assess whether any of those 2 indicators exist. If not, they can move on from the impairment. So it's been simplified in respect of the indicators. but not in respect of the need for impairment testing and determination. Given the reaction I got when I talked about leases earlier, I'm guessing that we're all waiting to find out what the board was proposing in respect of leases. What the board is proposing is that leases come off balance sheet. So there will be no differentiation between operating and finance leases. For a lessee, leases expense will be recorded as an expense through the P&L with disclosure of commitments. So effectively back to where we were. Now, what the board hasn't yet decided is what happens on transition. Because if you are an entity that potentially could use this tier 3, but you've been booking your leases and you sick of booking your leases and you want to go back to this, what happens on transition? So that hasn't yet been determined, but that's what the proposal is for lessees. For lessors, you would recognise your income on a straight line basis. So that whole differentiation between types of leases would not exist. Again, I mentioned at the start that this was a combination between making things simpler and things in accordance with the conceptual framework. This is very much a simplification. Any questions or comments on that one? Yeah.
Would you still have to do for the disclosure, would you still have to do all the complicated mathematics?
No, disclosures will be similar to the old leasing standards, so basically commitments.
Just lease commitment.
Yeah.
So when you mean the complicated mathematics, you mean calculate it as if you were going to, yeah, no. Yeah. The other one that people are often waiting for with bated breath is what is the board proposing to do in respect of income? Because the current income standards is causing a fair bit of angst for a lot of people. So again, the board spent a huge amount of time trying to determine, looking at various agreements and trying to work out what would be the most appropriate answer for this tier 3. So what effectively they've said, and I know whenever I talk to people, they always tell me they want matching. Just bring matching back, then we'll all be happy. Matching means something different for everybody. So the board is very consciously not saying anything about matching, because if all the standard said is match, people would still do very, very different things. So what the board are proposing is to say, if I give you some money, I'm your funding provider and I give you some money, do we have a common understanding on how that funding is going to be spent, what it's going to be used for? So we've agreed in writing that you are going to employ 2 people for the next 2 years to perform counselling services. Common understanding that's documented about how that funding is to be spent. And if that is the case, what these proposals say is that revenue will be recognised as that salary is incurred. So it will be recognised on a straight line basis over the 2 years. So many of you might say that's matching. It's matching the revenue and expenses. And possibly it is, but the board has very clearly not used that terminology. It's about recognising the revenue as that agreed expenditure in accordance with the common understanding has been incurred. So they're the criteria. We have to have a common understanding and we have to have documented evidence. Now, in respect to the documented evidence, again, this is only a discussion paper. It's not saying that there needs to be an absolute signed sealed document. An email could be the documented evidence that you've got, but there does need to be some sort of documented evidence around that. So I'm happy to take any questions on that one.
Is there any plans for non-tier 3s above, like tier 2 or tier 1?
So remember, it's not about post-implementation review and comments on the current, yes, that's where that would come through. So this is very much no changes to the tier 1, tier 2, but the post-implementation review is running at the same time. It allows people to comment on that. And it purely depends on the feedback that we've got. I've been at some of the discussions around tables, and there's been comments that it's not broken, so don't fix it, which is quite different from what I hear in a lot of sense. So hence I really do encourage people to give some feedback on that one if they do have some.
And one thing what I would point out that decision tree and considerations board will take for tier 1, tier 2 are actually different to tier 3, because here clearly we are departing from the conceptual framework in the sake of simplification, whereas for tier 1, tier 2, that's not well, the cost benefit equation is just different.
Employee benefits. Generally, we don't hear a huge amount of issues about employee benefits, and many not-for-profits do just have volunteers, so this is not an issue. However, The board, when they looked at this, considered that they should have some information in respect of employee benefits. So the proposal at the top is exactly what you'd expect. You recognise it as an expense from the services incurred. However, the simplification is that there would be no discounting. So for your long-term benefits, you still wouldn't discount. What you would do, however, with your long service leave is you would reflect the probability that the payment will be required. And it has been discussed that possibly there would be some guidance that is put out, so all of the not-for-profits in this space use the same probabilities, and that would potentially be helpful. So I'm interested in the feedback on that. Not massive simplification, but hopefully will help in that long service leave calculation aspect. Financial instruments. As much as we would all love to move on from financial instruments, we all do have financial instruments, because even if we just have cash receivables and payables, it's a financial instrument. So consequently, the board spent a huge amount of time trying to work out what they're doing with financial instruments and what type of financial instruments the not-for-profits have, because they want to make sure that they cover the common ones without putting huge complexities in there for things that a couple of not-for-profits might have. So what the board is proposing is to split financial instruments into basic financial instruments and not basic, effectively complex financial instruments. And what they're proposing is that they will write guidance for the basic financial instruments. So the first question that you've got, question 12, is this is the list that the board is proposing will be basic financial instruments, so the common ones that they believe that the not-for-profits will have. Do you think that list is right? Is there something that is fundamentally missing? Is there something in there that you go, no chance, no not-for-profit ever has that? So we've got our cash, we've got our receivables, we've got term deposits, we've got managed investment schemes, we've got payables, loans. So is there anything in there that fundamentally is wrong? So what are your thoughts on that one? So once we've got the list right, this is a really complicated flowchart when you initially look at it. So I'm going to try and talk through it and make it simpler for you. So we're going to effectively spend most of our time at the top part of the flowchart, where that basic financial instruments is there. So we're going to focus on assets predominantly. And where we're looking from an asset perspective is that there will still be split between assets that are held at fair value and assets that are held at cost. The assessment that a not-for-profit will make is, are they holding their financial assets for both income and capital return? If you've got something like a receivable, the answer to that is no. So you would just hold it at cost, exactly the same as you do. Where you might have that is if you've got things like a managed investment fund, you've got shares in listed entities. Now, the board proposal is that if you have those investments in managed investment schemes where you're listed entities, you will recognise them at fair value through other comprehensive income. Now, there isn't a specific survey question on this because we didn't realise as we were looking at this that there would be quite so much mixed feedback on this. So I would love it if you type in the chat box your thoughts, not the chat box, the comment box. What we're hearing is some people love that idea of all the movements going through the comprehensive income. Other people hate it because they don't know what the comprehensive income is and they'd much rather have all the fair value movements in the P&L. So what we've seen so far is a fairly mixed view on whether it should be fair value through P&L or fair value through OCI. There seems to be advantages and disadvantages for both. So if you have a strong view of where those fair value movements should go, it would be great if you could type that into the comment box. So that would be the proposal for your financial assets, your receivables, etc. Just do as you normally do. All of those other investments will go through fair value. Financial liabilities held at cost, the way that we normally do at the moment. Impairment. So we're talking about your bad debt provisions. We moved a couple of years ago when we moved to AASB 9 from an incurred loss model to an expected credit loss model, which is where we were expected to take a step on day one and say, what do we think the loss is going to be? Realistically, from what I've seen, the not-for-profits probably didn't change very much in their trade receivables and their bad debt provisions. What is being proposed under tier 3 is to go back to that incurred loss model. So when it is probable that the carrying amount of your receivable is not recoverable, you would put a bad debt provision, right? So you have to effectively have that evidence that you would not get all of what you had hoped. From a derecognition perspective, not a huge amount of change there. And so we derecognize those when generally they have been settled or we've lost control. But everything else that is not basic, you are being flicked to AASB 9, the financial instrument standard, because the board, whilst had said, proposed that this would be a one-stop shop, they also don't want to make it bigger than Ben-Hur and have everything in there. So if we've got that list of basic financial instruments right, if you've got anything else, they propose flick you up to AASB 9. So I'll give you a second just to answer that question. Yeah.
What about investment in unlisted shares?
Sorry, I keep calling it investment in listed shares. Any investments in equity shares.
So it has to be at fair value.
Yes.
It's
Yes.
no option for cost.
No option for cost. Yeah. So I mentioned that the board was proposing a split between basic and complex, and we've just looked at what the accounting was for basic. What this question is to say, these are some things that possibly the board is on the fence about whether explicit guidance needs to be included in the tier 3 standard. So you are ticking the box only if you think there should be guidance on this topic within the standard. So if you have a look at that list, do you think that they're common in your not-for-profits that you work with? Do you think explicit guidance should be in, or would you be comfortable not to have any explicit guidance in relation to these? So if you're happy that they should be out, do not tick the box. As in, they shouldn't even be covered as a topic in tier 3. So we wouldn't have any explicit guidance on, for example, financial guarantee contracts, because they're not deemed to be common in the not-for-profits. Yeah. Changes in accounting policies and corrections of errors. So what we've been used to when we since we transitioned to IFRS is every time we change something, we change comparatives. And that's what we've always had drilled into us and stayed on. And then we got the revenue standard, and then we got the leasing standard, which introduced this, well, another change in comparatives. And for a year, we had this weird non-comparability thing. But the world didn't fall apart by doing that. So consequently, when the board was looking at what did they do around changing accounting policies and our errors, what they are proposing is for any voluntary change that you decide to put through. So you are choosing to change an accounting policy based on the choices that would exist. And any errors that you found, that you do not need to change comparatives. That's what the modified retrospective is. You only make that change at the beginning of the current year, and you put it through retained earnings at the beginning of the current year. So you leave your comparatives the same. Again, conceptually, not pure, much easier. And we have got that precedent because that's what we were seeing with the revenue and the leases. You change your accounting estimate, change bad debt provision, you change any other provision, then you take it going forward, as we always do. And based on the feedback, the board will then decide what to do about mandatory changes. So if there is change to a standard and you need to change the policy, what will happen then? So are you comfortable that we do not change comparatives if we have change in accounting policy or impact?
Will it be optional or will it be one way or the
The
other?
proposal is that it's not optional. The proposal is that you do not
change. Okay.
Yeah. So if you disagree, if you think it should be optional, your answer is no with a we prefer an option. Yeah.
Disclosure around what it would have been.
No. No. They didn't.
Just hide it in the table.
Yeah, exactly what we did with the revenue and the leases. We just effectively said these are the changes now, and this is the impact on that opening retained earnings and that opening balance sheet. But last year was last year. Yeah. So we've got a few quick fire questions. Borrowing costs to be expensed as incurred, which is what for the majority of you is probably what happens. The only difference to that at the moment is if you have a qualifying asset, an asset that takes not necessarily longer than 12 months, you have to capitalise it. So you don't need to worry about that, you just expense all of your borrowing costs. The board is proposing that all sets of financial statements under tier 3 should have a balance sheet, a P&L, cash flow statement. I know the survey uses statement of financial position. I was just lazy when I wrote the slides and I used the terms that I would speak. So it's not that the names aren't mandatory. So it's those 3 primary statements that the board is proposing that we absolutely need, and notes to the financials. The one that is not talked about, I will talk about next. So are you comfortable that we should have those 3 statements? So we've got 2 questions on the statement of changes in equity, and that's the one that the board can't agree on. So your statement of changes in equity is where you effectively reconcile your net assets from one year to the next. So you pull most of the figures from some of the other statements. There has been mixed feedback around whether an entity should always be preparing a statement of changes in equity. And that mixed feedback has been that if all you have is your retained earnings reconciliation, you don't have any reserves, kind of a bit of a pointless statement. Other people have said that if you have more than that, it's a bit of a sense check as well, and it shows all of those movements. So the first question is, should it form part of the primary statements? So should it always be mandatory for each entity? The second question is, if it wasn't part of the primary statements, would you be comfortable that that information should be in the notes? So yes is it should be in, no is we actually don't think that information is needed, or any of those alternative. Separate financial statements. So this is if you were not doing your consolidation, this is where you are doing your effectively your parent entity financial statements. So there would be a choice on how you account for those investments. Your choice would be at cost, fair value through other comprehensive income, or you are able to use the equity method. It's very similar to what exists at the moment for any parent entity preparing those parent entity columns. So we've got another round of quick fire questions. Question 21. Now at this point, some people's numbering goes a bit different when I run these sessions. As long as you're on the same topic as me, I don't know why the numbering goes different. So if you're in a different number, don't worry about it as long as you're on the same topic. So inventory, the proposal is there would be no changes. You keep doing what you are doing. Inventory is held at the lower of cost and net realizing. You've seen as we've gone through, there's been a fair number of proposals where there is an option to hold things at fair value. So the proposal is that the definition of fair value will not be changed. There was discussions about whether it should be, a rateable value or some other simplified value. But it was decided that that would lose really the integrity of what fair value actually is. So the proposal is no change to the definition. The 2 questions you have in relation to this is, it would propose that the language would be simplified and the basis would give more guidance around that. So do you agree with that? Is your question A? For question B, there's my answer to your question. I just contradicted myself from what I answered your question earlier. If there is insufficient recent information to measure fair value, then you can use cost. So you have to try and get your fair value, and the proposal is that you could do that. So apologies for giving one answer. What do we think in relation to that?
But the cost is then meant to be the best measure of that fair value in those circumstances. So I would still call it fair value. It's just the cost being the measure of the fair value. So it wasn't necessarily wrong. It's just that.
You didn't jump in.
Yeah, no, that's why. Yeah.
Did someone go to ask a question then? No.
So if it's holding more than 12 months, I can still say there is insufficient reason information available, and we can stay using cost.
So if you're holding it for more than 12 months, so by that do you mean, so it's more than 12 months since you bought it, so you can't use your cost, your fair value information? No, you'd still have to try and investigate, see if you could get information about the results of the entity, the dividends of the entity, how it was performing. So you couldn't say we've held it for a while, so that we don't have any recent information. You've got to go out there and hunt for some recent information. It's not a default that you go, we've held it for a while, it'll be fine. Yeah.
And that just shows that there will be still a level of judgment to be applied in the tier 3. It's not just a set of rules. Well, again, subject to the feedback.
Non-current assets held for sale, not a standard that's overly well complied with in my experience, but the proposal is there will be no change. So this is where if you've got a non-current asset that you were holding, you're now planning on selling and it meets certain criteria, you classify, you measure it differently, and then you stop depreciation, you have to potentially write it down and you present it differently on the balance sheet. So that one there would not be any changes for. Associates and joint ventures. So they're not really common in my experience in the not-for-profit space, but we are aware that there are some not-for-profits who have their associates and the joint ventures. So the proposals depends on what you were doing way back in question 6, I think it was, about consolidation. So if you are a parent entity who is preparing consolidated accounts, you will use the equity method, the same as what we do. If you are a parent entity, so you've got subsidiaries, but you've chosen not to do consolidation, you're doing separate financial statements, you have a choice of cost or fair value through the comprehensive income. And if you're just an investor, i.e. you don't also have subsidiaries, you do have that choice again. So very similar to what we've got at the moment, it just means a little bit of thinking about what are you actually doing in respect of your consolidated accounts, what type of entity are you. So we don't see a huge number, or I certainly don't see a huge number of associates and joint ventures in that accounts. Oops. Question 25, property, plant, equipment and investment property, no changes. So you are still able to record at cost or at fair value, except the change we talked about for borrowing costs. So you wouldn't be capitalising borrowing costs on top of those, but otherwise no change for PP&E or investment property. Volunteer services. So volunteer services at the moment, if you are in the private sector, which I'm assuming everybody in the room is, you have a choice about whether you record your volunteer services or not, if you can measure them reliably. The proposal is that choice will remain. So if you can determine fair value reliably, and you want to record your volunteer services, which is income and expenditure recognition, you can. Choose not to, you don't. Question 27 is for these topics here. The proposal will be effectively that there are simplified words, but the treatment will be exactly the same as what we do. There has been very few comments on that, apart from where we've got some comments in brackets. So for foreign currency translation, you'd apply the rate at the transaction date or at the end of the reporting period. And for tax, which again probably won't have a huge impact for most of you, there would be no deferred tax assets and deferred tax liabilities being reported. So those topics are kind of the sweep in, we haven't heard a lot about them. So they're the ones that will be simplified words in my plain English. Intangible assets. The board hasn't made a decision on intangible assets, and the primary reason for that is because they don't feel like they've got full transparency on what intangible assets a not-for-profit has. So you can have a look at the financial statements of not-for-profits, and the staff are doing a project to look at common transactions. However, just because you are not showing it on the balance sheet doesn't mean you don't have it. So certain not-for-profits potentially aren't reporting it. So in trying to decide whether they include intangible assets as a section within this standard, they really need to get a feel for what type of intangibles you've got. So this question is not about do you agree with accounting? This question is what type of intangibles do you have within the organisations you work with? If you do press other, we would love to hear what that is, what you've actually got. So to understand the prevalence and to understand what type of guidance the board should be putting in. Let's give you an extra few seconds to look on those intangibles. So the next one is about disclosure. As I mentioned, this is a discussion paper. It is not an exposure draft, which would be effectively a replica of the standard. So the board didn't want the staff to spend days and days and days writing disclosures for all of these when there's still very much uncertainty around what this standard might look like. So what the board have proposed is some principles around what the disclosures would look like. So if there is a difference between tier 1, tier 2 and our tier 3 proposals, what the proposal is that there will be specific disclosures that are developed. So they may use some of the tier 1 disclosures, tier 2 disclosures as analogy. They may look at other jurisdictions that have a similar measurement criteria and use those, including potentially IFRS for SME. Where they are the same, they will use the disclosures that are currently in tier 2 with any simplifications if appropriate. So within the survey, there's a couple of standards and it kind of gives you an indication of the principle, how that would be applied. So we're not asking you here, do you agree with all of the disclosures? We're kind of saying, does that principle make sense in the way that those disclosures would be developed? I said that a couple of times this would be a standalone standard, but it's not meant to include absolutely everything it possibly could. So this is what the board is looking at this point in excluding, not having anything in there at all about it. You tick the box if you think the topic should be included. The feedback that we've been getting is that business combinations, particularly mergers, we call it business combinations, we say mergers don't exist for accounting, but we're hearing that in the not-for-profit space, the mergers is something that possibly does happen quite a lot, and it would be useful to have some guidance in. Otherwise, nobody generally is jumping up and down about any of the other topics. So if you think there should be guidance on any of those, please tick the box, that would be very helpful. So we've just talked about the items that are proposed to be excluded. So what if you have one of them and it's not in the standard? What do you actually do? So this is the hierarchy that would be included. If the reporting, if the transaction or the balance that you have is in tier 2, you would go there, and that's what you would look to and use the guidance within that. If it's not in tier 2, and we then do exactly the case that we have at the moment, if we have a balance or transaction that isn't in the standards, we have to look to developing our own accounting policy. What the difference would be, however, is that, that should have the word transactions after it, you would use the principles in tier 3 rather than the principles in tier 2. So there are some slight differences, there are some simplifications here. That's what you would use. You can look at the conceptual framework in respect of the definitions of assets, liabilities, income and expenses if they don't conflict with the general requirements of tier 3. So that's just the guidance in how you would develop your own accounting policies if you had a transaction that was not in tier 3 and was not in tier 2. Personally, I think it would be fairly rare in the not-for-profit space, but we need to have that place for you to look if that happens. Getting towards the end, and I think it would have finished not far on time, so that's pretty good. All right, so this question, there would be at least 2 years between the issue of the standard and the effective date of the standard. So whilst people would be able to early adopt it, anybody who it is deemed to be mandatory to adopt this would have that time period. So would you be comfortable with that 2 years? The board is also proposing that this will not be a standard that changes every 2 minutes. So the board is proposing that once the standard is issued, the amendments will be made not more than once every 5 years. So the not-for-profits do not have to sit and listen to me tell you every year what the difference is in the tier 3 changes. That's not happening for tier 1, tier 2, but for tier 3 it would be locked in. So would you be comfortable that was the case, which could mean that there are big differences between our tier 3 and tier 1, tier 2 if there are changes, but it gives some stability. Question 34 is the AASB do not believe they should be the ones that have developed thresholds in relation to this. So I have very carefully, as I've been talking today, I've been talking about certain not-for-profits and being able to use that. When the board were thinking about the common transactions, they had in mind the 500,000 to the 3 million revenue, that medium tier for the ACNC entities. The board, however, have said that it is not up to them to decide who can adopt this. The ACNC, if we use those as our example, might decide that tier 3 is the best thing ever and they're happy for every one of their charities to use it. They might decide that it's only for the medium tier. We are working with them quite closely, so hopefully they don't decide that they hate it and nobody can use it. But same as any other legislator is able to decide who is able to adopt this. It would be something that ASIC would be looking at and Treasury would be looking at it. But at this point, the AASB do not believe that they are the ones who should be deciding thresholds in relation to this. So do you agree with that? Service performance reporting, which is effectively your non-financial reporting. Tell me about all the great things that you do. Tell me about your outputs. Tell me about your outcomes in respect to your strategy. Is not something that is proposed to be part of this tier 3 project. It is a separate project. It's a project that was started by the AASB a number of years ago and then put into hibernation. It has been reinvigorated and has been recommenced. But the proposal is that that will be a separate project rather than it being part of tier 3, which will delay the tier 3 project. So are you comfortable that they are separate? Now we have hit 10 o'clock. I reckon I've got 3 minutes more. So if we can give me 3 more minutes, that would be marvellous. And then we all get to hit submit. Question 36. As part of this project, so any of you who are familiar with the for-profit space would be aware that certain for-profits now can no longer do special purpose financials. As part of this project, the AASB would be looking to do the same for not-for-profits. So if not-for-profits have legislative requirements or have other requirements to comply with Australian accounting standards, they would have to do general purpose financial statements. That would include the tier 3 if the legislators decided it was appropriate to them. So given everything you've heard about tier 3 and the simplifications, would you be comfortable that that was the case? The AASB at this stage is not proposing to develop a 4th tier. There was some discussions about possibly a 4th tier for really small entities, possibly some sort of cash accounting, but the AASB are not proposing that. Are you happy with that? And as we've alluded to already, this is a very distinct tier 3 project. There is not planned to be any changes to tier 1 or tier 2 as part of this project. I have talked about the post-implementation reviews that are happening, so your opportunity to influence the tier 1, tier 2, but this would be very distinct to tier 3. The last 2 questions is just some information about not-for-profits that you work with. And the very last one is if you would like to have a specific chat to any of the AASB staff, if there's some things that you're really passionate about one way or the other, staff would love to have a chat with you. So if you want to include your details on that. And we have completed the survey after I said I didn't think there stood any chance of doing it, and I went 2 minutes over. So thank you for your contributions. As I say, if you have people that you think might benefit from filling this in, anybody in your network, the more feedback that the staff can get and the board can get, the better. We've just cracked it out in about 45 minutes, and that was me talking you all through each of those. It's much quicker if you read the 12-page document and do it yourself, but it's also still benefit of me sharing what we've got. So please watch this space in this. It will be being discussed at board meetings that are happening. Comment periods close on the 31st of March. So there is still some time to do that. So I'm happy to take any other questions on that. If not, am I handing back to you, Aidan?
I think so.
Okay.
Just give me 1 minute.
So any other questions?
Thank you, Carmen, for all joining, and thank you, Carmen, for that. If you do have any other questions, you can speak with Carmen. You can reach out to me or Kim. If you're not sure, reach out to Kim, and Kim can point you in the correct direction as well. So, Joe, it was a fantastic session and very informative. Now, before so a reminder, on the 22nd of March, we've got our ENFP event where we have the new commissioner. We got Sue Whipper coming, and also one of the directors of ACNC, Neil Yates, giving us an ACNC update. So, if more information, you want to come up with your phones and scan this QR code, or speak with Kim about that. And yeah, that was one of our most popular sessions. All right, thank you everyone once again for your support, and thanks, Carmen, again. See you all soon.